everyone, and welcome to our session on cash transactions. My name is Rika Dry, and today we're going to learn about something that affects almost every part of our daily lives: how businesses receive and spend money. By the end of this lesson, you'll understand what a cash transaction is, the different ways we can pay for things, and how businesses keep records of all these payments. You'll also learn about the documents that serve as proof when money changes hands. Let's get started. First, let's define a cash transaction. A cash transaction happens when a business receives payment immediately when the sale occurs or when it pays for something right away. For example, if you go to the tuck shop and pay for a sandwich with coins, that's a cash transaction. If you swipe a debit card and the money comes straight out of your account, that is also considered a cash transaction. In other words, in a cash transaction, there is no waiting period. The money moves on the spot. Remember, cash here doesn't mean notes and coins. It includes payments through debit cards and electronic transfers, as long as the payment happens immediately. Imagine a student-run tuck shop. Siswe swipes his debit card to buy a juice. That's a debit card payment. Mbali pays using her phone's EFT app. That's an instant transfer. And Musa hands over 20 Rand in notes. That's physical cash. All three are cash transactions, even though only one uses actual cash. So businesses receives cash in different ways. A debit card payment. This is when you swipe or tap your debit card and the money goes straight from your bank account into the business's bank account. An electronic funds transfer, or EFT, happens when you pay online or use your banking app to send money to the business's bank account immediately. And physical cash, rands and cents, is when you hand over notes and coins at the till. All of these count as cash transactions because the business receives the money right away. When a business makes payments, it also uses cash in different forms. For example, a business can pay a supplier with physical cash or transfer money electronically through an EFT, or use a debit card linked to its bank account. It is important for businesses to keep track of every payment because they need to know how much cash they have available. It's also safer for businesses to use electronic payments because carrying lots of notes and coins can be risky. Another payment method is a debit order. But what is a debit order? A debit order is an instruction that you give to your bank to allow a business or organization to take money from your bank account on a specific date, usually every month. Let's say your parents pay for your cell phone contract. Instead of paying it manually every month through an EFT or a debit card payment or cash, they can set up a debit order. The cell phone company will then automatically take the money from their bank account on the same day every month. Important things to remember about debit orders is that you must give permission for the debit order. It is used for regular payments like gym fees, insurance, loans or cell phone contracts. And you need to make sure that there is enough money in your bank account on the date the debit order will go down or the payment will fail. In this image, you can see the difference between cash transactions and credit transactions. A cash transaction is paid immediately. For example, if you buy airtime with cash, the shop gets the money right away. A credit transaction is different. In a credit transaction, the buyer takes the goods or services now, but pays later. Think of buying clothes on account. You take the items home and settle the bill only after 30 days. This is why businesses must record carefully whether a sale was for cash or credit, because with credit sales, they need to remember that the customer still owes them money and must come and pay for it at a later date. But for this lesson, we will continue to focus on cash transactions. What is the role of the bank account? Businesses almost always have bank accounts. When a business receives cash in the form of a debit card payment or an EFT, that money goes straight into the bank account. Even if they receive physical cash, they usually deposit it in the bank so it can be safe and used to pay suppliers. Why is this important? Because a business must know exactly how much money is available to pay bills or order more inventory. If the cash isn't recorded properly, they could accidentally spend money they don't have. And the bank helps keep the money safe. How do you think businesses can safeguard cash? Because cash is valuable, businesses must protect it from loss, theft, or mistakes. Internal controls are the rules and procedures that help safeguard cash. Here are some examples of how a business can safeguard cash. All payments should be made by an electronic funds transfer, because this leaves a clear electronic trail. There should be proper authorization, which means only certain people are allowed to approve payments. At least 2 staff members must check important transactions, because this prevents errors or dishonesty. Staff can be rotated, so no one stays in the same job too long without oversight. Reviewing receipts against deposits will ensure that records match the actual bank deposits. Cash should be banked regularly so it doesn't sit in the till for too long. And segregation of duties, which means that different staff members handle different parts of the process. These controls help businesses avoid fraud and mistakes. I want to emphasize segregation of duties. This is one of the most important control principles. This means that different people must do different tasks. For example, one person authorizes a transaction, another records it, and a third handles the asset or money. This prevents fraud and makes mistakes easier to spot, because no single person controls the whole process. This runs through all processes of a business like a golden thread: cash transactions, credit transactions, management of assets, and even inventory. Whenever a cash transaction happens, there must be proof that money was received or paid. We call these pieces of evidence source documents. Let's say the tuck shop buys chips from a supplier. If they pay with 200 Rand in cash, they must keep the receipt. If they use a debit card, the bank app will confirm the payment, but they will also receive a slip from the shop. If they EFT the money, it will reflect in both the suppliers and their own bank account on the bank statement. They will also receive an internet notice of payment. Let's look at some examples. A cash register roll shows all the sales made at the till. A cash slip is what you receive when you pay at the shop. An invoice shows details of items sold, sometimes paid immediately, sometimes on credit. An internet banking notice of payment proves you transferred money online. A credit card slip shows card payments. A receipt proves payment has been received. A petty cash voucher records small cash payments inside the business. A bank statement is an official record from the bank showing all transactions. These documents are essential for keeping accurate records and for auditing purposes. As we just mentioned, when a business makes or receives a payment, there must be proof in the form of a source document. But not all source documents are the same. Some come from inside the business and some come from outside the business. Internal source documents are created by people inside the business. For example, a cash register roll printed at the till, a duplicate receipt written in a receipt book by the shop, a petty cash voucher completed by a staff member, or a payment instruction signed by the manager. These documents stay in the business and are used to record transactions that the business is responsible for. Now let's look at external source documents. These come from outside the business, from customers or suppliers. For example, a till slip you get from the shop when you buy something, an invoice sent by a supplier, a bank statement sent by the bank, or proof of an electronic funds transfer emailed to you by a customer. These external documents are important because they confirm what happened with people or businesses outside your own. So remember, internal documents are created by your business. External documents are received from outside the business. Both types are needed to keep proper records and make sure every cent is accounted for. Something else that's important when it comes to source documents is the difference between an original document and a duplicate. When a business gives or receives money, it usually creates a source document in two parts, the original and the duplicate. The original is the first copy and is usually given to the customer as proof of the transaction. For example, when you buy a cold drink at the tuck shop and the cashier tears out the original receipt and hands it to you. The duplicate is a second copy that stays with the business. It's kept in the receipt book or filing system to make sure the business has its own record of what happened. This system helps both sides keep proper records. If there's ever a disagreement or an audit, both the customer and the business can go back to the documents for proof. So remember, the original goes to the customer and the duplicate stays with the business. That way, everyone has a copy of what happened. After collecting source documents, the business records the information in its subsidiary journals. A journal is simply a book or an electronic record where every transaction is written down in date order. For cash transactions, we mainly use the cash receipts journal to record money coming in and the cash payments journal to record money going out. Think of the cash receipts journal and cash payments journal like a money diary. You write down every time money comes in and every time money goes out. just like balancing your pocket money. If you forget to write things down, you might think you have more money than you really do. That's why accurate record keeping is essential. Recording in journals helps the business know exactly how much cash they have, which payments are complete, and which still need attention. They can also keep record of the income they receive. Are they profitable, or do they need to increase their income or decrease their expenses? Where will the transaction be recorded? Clean It Up Services rendered cleaning services at Waja Secondary School. The head of finance paid the services with cash. In what journal will Clean It Up Services record this transaction? So let's have a look. Clean It Up rendered the service and they received the cash. Therefore, this transaction will go into our cash receipts journal. Let's now look at the other side of this transaction. In what journal will Waja Secondary School record the transaction? So if we look at the transaction, Waja Secondary School received the services from Clean It Up, and the head of finance paid for the services with cash. Since they made a payment, it means this transaction will be recorded in the cash payments journal. Where will this transaction be recorded? On the bank statement of Clean It Up Services is an entry for a debit order paying the monthly advertising fee. So in which journal will this transaction be recorded? A debit order was used to pay for advertising, and today we learned that a debit order is a form of a cash payment. Therefore, this transaction will be recorded in our cash payments journal. Let's do another one. Where will this transaction be recorded? Clean It Up Services received an internet banking notice of payment when a client paid for services rendered. So in which journal will this transaction be recorded? A client paid Clean It Up Services for something Clean It Up Services did. So Clean It Up Services received the money through a direct deposit into their bank account. So this is a cash transaction and it will be recorded in our cash receipts journal. Remember these important points. A cash transaction is any payment received or made immediately. Debit cards, electronic funds transfers, and debit orders are examples of cash transactions. It is not only notes and coins. The cash receipts journal records money that comes into the business, therefore money received. The cash payments journal records money going out, therefore cash payments. And always keep your source documents. Now for some homework. Can you and your classmates have a look at different source documents you or your parents received while paying for things? Have a look at the information that appears on each of these source documents and start thinking about how this information will help you to record the transaction from the source document in your cash receipts journal and your cash payments journal. Thank you for being such attentive learners. Accounting helps you understand and manage money, whether it's coins in your pocket or a payment into your bank account. You are one step closer to being a business champion.